Welcome back to another episode of the Educated Homebuyer Live. This is where Josh and I take your questions, we answer them so that you can become the educated homebuyer. On top of that, if you're new to the show, we take the first 10, 15 minutes here and talk about what's happening in the economy, what's affecting housing, whether it be mortgage rates, whether it be consumer debt sitting at $1 trillion, whether it be CPI tomorrow, right? We're going to talk about all of this stuff that's happening right now in the market. Again, to help you become the educated homebuyer. Josh, welcome back.
Jeb, I'm just happy to be here with an internet connection that we're not running around cussing at things, kicking things, trying to punch the internet box.
The internet box. Oh, that's great. We've just classified the internet. It's just a box you buy.
It's just a box. It's a box. It's a box on the wall that makes us connect to you, the educated homebuyer viewers.
There we go. So, over the past week, not really a lot happening other than mortgage rates kind of bouncing all over the place, right? We've seen volatility, more and more volatility. The big news really comes tomorrow. As many of you guys know, we get the latest CPI report, which we're going to talk about in a little bit more detail in today's breakdown of what's happening out there. But that's really kind of, in my opinion, going to be a big indicator of what happens probably over the next month, right? Until the next report comes out. There's a lot of other information out there, but what we know at the moment is that the Fed, while they don't control interest rates, they do control, short-term rates. And what we've seen is because of the volatility happening in the Fed funds and different things out there, it's creating chaos in the bond market and in turn affecting rates. So a lot of what happens tomorrow could help rates. It could hurt rates. It could probably be built in, which is probably, I think, what is more likely to happen than anything else. But with that, Josh, we're going to take a look at some charts as promised, and then we are going to dive into your questions. So start putting them in there right now if you're not doing so already. That way we can just flow right into it. There's no lag and really just provide you some value in today's episode. So as we do every week, we take a look at inventory nationwide. Added just 3,000 homes, guys. That's not good. And you're going to see what that, looks like compared to years past here in just a minute. But 487,870 homes, a lot of 4s and 8s, or a lot of 8s and 7s rather in that number. Orange County, sitting at 2,448. For those of you following Orange County where we're located, that's up about 100 properties from last week. So trending, in the right direction if you're a home buyer out there. Huntington Beach actually dropped a couple homes from last week, sitting at 190. And these are charts that we look at every week. So why isn't inventory growing? The primary reason is we don't have new listings coming to the market. You need more and more new listings coming to the market in order for inventory to grow, right? You need more homes coming than people are taking off the market in order for, to not have that imbalance, if you will. As you can see from this chart here, inventory moving sideways to down at the moment, which means less homes are coming on the market than are going under contract, and therefore we're not really seeing a huge build in inventory. What's happening is you're seeing the build in inventory from homes sitting on the market longer than you are new listings coming to the market, which is really key to keep in mind. And one thing I forgot to mention, if you're watching this, listening to this, there will be a link in the description of the show notes where you can grab these charts. So if you're listening, driving in your car, you want to say, hey, what is Jeb looking at right there? What is Josh talking about? Go check the description. There will be a link there where you can download it. We'd like to take this view of inventory. This goes all the way back to 2015. And the reason I like this chart is it shows seasonality in the market, shows the ups, the downs, but what it shows more than anything else is a downtrend in inventory, over the last 7 years or so, and why we're having such a problem at the moment, even though rates are higher, right? Rates are higher, but it's still a battle out there for many home buyers because there's just it's not a lot of property to buy. And that is, a problem. And what you're going to see, if you look here seasonality wise, we're going to be peaking in inventory really soon, which means less options out there in the market. And this is the weekly change I was talking about. We went from 484 to 487. The same week last year, we went from 538 to 543. So last year, we only increased 5,000 homes this same week. This week, we increased 3,000. So not a huge difference in the number from this time of last year. But the problem is this year, we haven't had any big weeks, 30,000, 40,000 homes coming to the market in a week. It's been a lot of 8s, 10s, 5s, and that's why inventory is low. Right now we're at the peak.
The 8s and 10, Jeb, are the ones that are mine. The 5s are yours. The 8s and 10s come to Josh. The 5s flock to Jeb.
There you go.
That's all I'm saying.
Yeah. On a scale of 1 to 5, he is correct. On a scale of 6 to 10, he's wrong. But anyway, here we go. This shows us pendings versus new homes going under contract. Basically 10,000 fewer homes, or 10% rather, fewer homes going under contract this year than we did last year. 5% fewer new contracts in the market this year than last year. So, we look at that. We'll explain it in a little bit more detail here in just a minute. That's a chart we look at every single week. I don't really like the chart so much, but it gives us an idea, just showing home prices are essentially listed at the same price they were as last year, sitting around 450,000. Versus the median price of new listings coming to the market being around 400,000. So I don't like the median number. I don't like median in any way, really. It's an indicator that a lot of people talk about. That's the only reason we really show it here. And again, another median, just showing median price of homes in contract, more or less unchanged, sitting at 385,000, which is a little bit higher than we were last year. And that's why you're seeing these month-over-month increases in home values now, right? And Black Knight's actually, based on their model, we're sitting at the highest levels that we've ever been at. Delinquency rate. This is important because what you hear is a lot of people talking about foreclosures and, when it all hits the market, that's going to change everything. Well, guess what, guys? We are basically still at historic lows. We're off the bottom of historic lows, but if you go back and look at pre-pandemic, we're still well below those numbers, which gives you a really good idea of where we are. In fact, the average between 2000 and 2005 was at 4.27%. We're at 3.12%.
Jeb, I was at a continuing education event yesterday and got to see one of the owners of one of our lenders, a lender that actually services the majority of their loans. They make as much money from servicing as origination. He just pointed out, we remember the fake news a few months back that FHA is allowing 40-year modifications. People were saying 40-year originations. Well, the 40-year modification is a real thing on loans going into the Ginnie Mae pools. Now Fannie and Freddie are doing the same thing. So there really was no other option. If you remember, we go back to 2007, 2008, lots of people have 6, 7, 8% mortgages. So you could do a mod for them and knock them down to 4 or 5% and lower their payment. Most of these people have 2.5, 3, 3.5, maybe a 4% interest rate. So the only way to
3% rate on a 40-year term. I mean, so basically like free money, like, hey, here's a free house.
If you're trying to mod someone, that's really the only option. But now Fannie, Freddie, FHA will all allow 40-year modifications. So, and he also pointed out something interesting. He was talking about the only foreclosures that they have going right now are people that were delinquent way back prior to the pandemic. So they were going to get foreclosed on prior to the pandemic. They got a 1.5, 2-year reprieve, still didn't make their payment. And now they're just buried with, 4 or 5 years of back payments, interest, penalties, all that fun stuff. And they're getting foreclosed on.
There you go, man. There you go. I thought this chart was interesting. This basically shows where the banks are with tomorrow's forecast, what they're expecting and where headline CPI will be versus where core CPI will be. So the consensus at the moment is that CPI tomorrow. So if you guys are following CPI inflation, we're currently sitting at 3% on headline inflation, core CPI sitting at 4.8. But if been following this at all, we're going to drop a 0.0 off from July of last year. Okay. Which means if a 0.2 comes on and we're at 3%, it's going to jump to 3.2, right? So the expectation, I think, is about 0.2%. Well, what you can see here from the banks, not going to read them out, it ranges between 3.2 and 3.4. I think it looks to be about 3.3 is where the majority of people are, which would be a little bit of a surprise to the upside on headline. But core, they see it dropping to 4.7. The Fed is really paying attention to core more so than anything else. So if we see headline go up a little bit, core come down, probably going to balance each other out, in my opinion. If you saw them both come down, might be a little bit of, goodness to the upside. If you see them both disappoint, that's where we have a problem, Josh.
And for the 10,000th time, the reason why headline is more volatile and the reason why the Fed doesn't look at it is it includes food and energy. So what do we have in the last month? We've seen oil prices start ticking up. You're seeing it at the gas pump. The second piece of it, the war in Ukraine has taken a turn here where Russia, since they can't win the war, has started now bombing ports, backing out from letting Ukrainian grain out. So that's the next phase. So much like we saw that knee jerk at the beginning of the war in Ukraine, where people were like, well, I don't know what this means for global food supply and prices. Both of those are a worry on the headline. So headline tomorrow is probably not going to be good. And when you look at the news, I'm going to give you a sneak peek at all of the headlines tomorrow and the things you're going to see on the nightly news or the cable news. They're talking, ooh, it looks like inflation is again ticking back up after being under control. Ignore it. Look at core. Core is what is going to tell you is things that the Fed can control and impact with their, campaign of terror for the last 18 months.
No, it's funny you say that. So prior to coming on here, I just jumped on stories on Instagram and I kind of dropped the video and said, hey, listen, guys, if you're following inflation or following this, the news media tomorrow is going to tell you that inflation is going back up, right? When in all reality, yeah, month over month, it ticked up. We're still in a downward trend, right? It more or less has to go up because of the 0.0 that we're dropping off. What you need to pay attention to is the headline, pay attention to the trend. Don't get caught up in the headlines, right? The headline is what is sellable to them. And that what gets the clicks. That's what gets the advertisers. That's what gets the money. That's what drives people crazy. People being me. Nevertheless, you mentioned something there, Josh, that made me think of something that I meant to mention at the beginning of the show. I'm just going to throw it out there now. Those of you in Maui, those of you who live in Hawaii, have family in Hawaii, really sorry. Crazy stuff happening out there at the moment. Wishing everybody out there like positive thoughts and vibes and all that good stuff. So this chart shows core CPI. So that was the number that we looked at a minute ago, the 4.8. That's going to be hopefully replaced tomorrow with 4.7. Maybe. Can we see 4.6? Can I get a 4.5, Josh? Can I get a 4.5? No, but nevertheless, so what we're dropping is that 0.309 there, right? If you didn't know, they actually round in CPI numbers, which can be really good or really bad depending on which way.
It's infuriating, Jeb.
That said, the following 2 months, which are going to fall off, which are August and September, are both high numbers compared to what we've seen in the past. So with those high numbers dropping off, we're likely to see lower numbers, 0.3s, 0.2s, hopefully, whatever those numbers are. And you've got shelter and rent data starting to reflect lower. You should start to see core come down in a more meaningful way. But again, we'll see
Jeb,
tomorrow. Yep.
Hold on before you go forward. So look at that. You have the giant ones in August and September, but look at 0.33, 0.31, 0.39. So call it 0.4, 0.41, 0.45, 0.385, 0.40. Let's look at expectations for the core tomorrow. 0.14, 0.23, 0.19, 0.15, 0.17, 0.2, 0.2, 0.23. All of those are literally half of what we see on the low reads going forward. So barring something unforeseen and a big turnaround and uptick in something in the core, we're going to see a number much lower. So the question is, do we settle in somewhere around 2.5 or do we get somewhere back where the Fed prefers around 2%?
Good stuff. Good stuff. All right. So Josh, what do we have here? I haven't had an opportunity to look through the chart. So we're just winging it, buddy.
So this is our friends over at the American Enterprise Institute. Says, despite the subdued rate of purchase activity, meaning not a lot of sales and high rates, year-over-year home price appreciation has begun to accelerate because buyers are well qualified, highly motivated with historically tight supply, cooling yet still strong job numbers, low levels of foreclosures, work from home, continued home price arbitrage opportunities. I'm not sold on their idea of home price arbitrage. They still think people are moving around the country and taking advantage of work from home and lower prices. But these conditions will likely continue. It's possible. I don't know that it's making a big difference, but these conditions will likely continue throughout the summer. Metros in the Midwest, which continue to be relatively affordable, are leading the recovery in home price appreciation. Our base home price appreciation calls for year-over-year appreciation of 6% and 7% by year in 23 and 24, respectively. So again, this is not to say that these guys are geniuses. They have a crystal ball. They're right. It's one of many expert opinions out there. This is kind of the chart of what they're showing. That's their projection there using optimal blue data ticking up there towards the end of the year. Let's put it in context, Jeb. You said the other week on the podcast that you saw the number since 1981, 1982. It's over 5%
it's like
annual
5.7, yeah.
We're talking 6 to 7% off of the heels of a really high number. So I'm not cheerleading for it. I'm not saying that's great. I hope to God they're wrong, and I hope we can settle in at 2, 3, 4% appreciation and not continue to see the 6, 7% creep up. I don't think that decreases in prices are good for anyone. Necessarily, other than a first-time buyer who's just trying to get in, but it's a bigger negative for the economy than any benefit for first-time buyers. If we could get 0 to 3% for 3, 4 years, I think it would be good for everybody.
So my question, Josh, if you're somebody and you're watching one of the crash channels, right, and you believe what they say, and they've been wrong in 2020, and they were wrong in 2021, and they were wrong in 2022, and they were wrong unless something unforeseen happens in 2023, and these forecasts are accurate, 2024. At what point do you say, this guy's wrong, this guy's an idiot, I no longer follow this, or do you just keep believing it and hoping and praying that it becomes true?
I don't have an answer to that, Jeb. I do have another question. When I'm looking at him, I say, are these people dumb or are they liars? It's one of those two options. Either they just don't understand data or they're liars. Our favorite, the guy over at Reventure, who's made a ton of money with views on here on YouTube, and also in terms of selling his data and his research, which has been wrong for 5 years in a row, horrifically wrong. But he came out with a tweet last week talking about M2. We've never seen a year-over-year decrease in M2 as large as what we've seen this year without a depression following. This is the third biggest year-over-year decrease in M2. And the two previous times, it didn't lead to a recession, it led to a depression. And he has the little scaredy face after that in his tweet. And you're like, oh, holy shit, that's terrible, right? Well, when you look at the chart of M2 growth, and you see the giant spike at the beginning of COVID, then the correction, this big year-over-year downturn, we are still 20% above the long-term trend of what money supply is, meaning there's more money sloshing around than ever. And those two depressions went from a normal level of money supply to a giant drop in money supply that led to a depression. So my question again, is he an idiot or is he a liar? I'm pretty certain he's a liar, because it wasn't hard to find the data that shows that is an incredibly misleading chart.
I'm going to go with the other option. Like, I think he's an idiot.
I think he's a liar.
We can have a debate. Idiot.
Liar.
All right. Hey, you guys let us know in the comments, which is he? I'd love to know what you think. Maybe I should put a poll up. I like the poll last week. We'll do that again. All right. Let's go back into some charts here, Josh. So this is I mean, a potential serious issue. Not so much for us at the moment, or, more so for the people that have it, but $1 trillion in consumer debt and credit cards. Holy cow. That's not good.
Two pieces to it. It's not only at high levels, it's accelerating. It's accelerated over the last quarter. I think, what was it? 4.6 increase, 46% increase over the last quarter. But if you remember, we showed a very similar chart here that wasn't just credit card debt. It was total household debt and how households have deleveraged over the last 15 years since the great financial crisis. This mirrors that. And again, looking at this is in absolute terms. We hit like 913 billion in credit card debt back in just before the downturn due to COVID. And so what happened is people got to pay down their debt because we were at home, couldn't spend any money, and lots of government stimulus. And many people actually benefited from it. So now we're definitely seeing it up here, but in real terms, it's probably not any higher than where we were heading into that. It's been trending up. There's no positive way to spin this, Jeb, but what I found very interesting is the next chart here. This is credit card debt as a percentage of total deposits. So assets, what you have in your bank account, your mutual fund, all that stuff, we are trending down. So we talk about, and this is down from back prior to the crisis, 2003, it's decreasing. And it went really low in the pandemic when we had all that stimulus. So I don't know, those are conflicting signals. Those two things tell you two very different things. And it may be why when we normally see a consumer stressed and spending more money on credit cards, they're doing it because they like their money in the bank. Whereas in the past, they didn't have money in the bank to fall back on. So again, lots of mixed signals we're getting from the economy.
And what do we have here? Payroll net monthly change. So less and less payrolls happening out there in the market, which shows employment going the right way or the wrong way, depending on how you want to look at it.
In terms of what the Fed wants, they want a job loss, not a job loss recession. They want joblessness, unemployment to increase. So if you look at this, that trend says by 24, late 24, early 25, we're at zero net job growth. A fact to point out about last week's jobs report is they use a birth death ratio. They're not talking about people, they're talking about businesses. And late in an expansionary cycle, it's been shown that overstates job creation and business creation. And you take that away, and we were already negative. So this tells us that the Fed is getting what they want. They just haven't acknowledged it. So now the flip side of it, why do they want less job creation? Because we have too many job openings. Labor has power to ask for more wages. This next chart here shows you average hourly earnings, a percentage change from a year ago, but this is for production and non-supervisory employees. So this takes out all of the CEOs, presidents of companies that make a ton of money. And you saw we had it plummet at the beginning of COVID, and then it spiked, and it's coming down, but still above where we have been historically. So 2015 through 2020, anywhere from 2 to 4%, we're still up here around 5%. So 40, 50, 60% higher than what we've seen historically. And that is what the Fed is concerned, that not enough labor. To get labor, you are having to pay more. And what I would say, Jeb, is the reality here, I think these numbers are terrifically skewed by people at the lowest end of the pay scale. We talked about this at the beginning of the pandemic. In-N-Out couldn't hire anyone. They already had high wages. Now you look, the sign says starting at 20 bucks an hour or 19 an hour. You see that at Del Taco. You see it at almost every fast food place. They're talking about they pay close to $20 an hour, where 3 or 4 years ago, we were talking about the national minimum wage because these places were paying $7.75, $8.75 an hour. So a lot of help for people at the very low end of the scale. I don't know that we're seeing as much at the higher end.
Agreed. And then we've got our debt getting downgraded. What does that mean?
So,
or not necessarily what does it mean? I guess let's compare it to other countries.
We had a question about this last week. What does it mean? Where is it coming from? If you look, the orange bar says the debt to GDP ratio. And if you look, to get a lower rating, you have to go higher than the US and or have a few other problems. So who's still AAA rated? Germany, they're only 46% debt to GDP. Australia, 44% debt to GDP. US, Japan is at 221. They're rated all the way down to A. We're AA plus. So it really means nothing, but it's telling you that the bond market is starting to tell these countries, you probably should pay attention to this because it's problematic. At an AA plus rating, it means you are almost completely not ever going to default, but they're telling you, please get your house in order and stop growing this number.
Speaking of getting your house in order, today we recorded an episode on the Educated Home Buyer podcast that is going to drop next Tuesday on how to budget. So if you're somebody out there looking to buy a home, you own a home, trying to figure out the whole budget thing, we kind of walk through it in really simple terms, I think, Josh, in a way that's easy to understand. So if you don't listen to the Educated Home Buyer podcast, go check that out. It's on YouTube, it's on Spotify, on Apple, everywhere that you listen. You can see our faces if you want to be on YouTube. If you don't, you just want to hear us, you can do that on the other platforms. But budgeting, and then that's coming off the heels of a Dave Ramsey episode where we kind of go through Dave's points and make our own points and what we agree and disagree with. So, if you like that sort of stuff, go check out that content as well. We would appreciate it. So, Josh, what are we looking at here?
So we've shown this chart in a number of different ways. I like this one because it shows on a percentage basis how much of GDP goes towards interest payments. So we were trucking along here between 2.5 to 2.8% and just spiked here up to 3.6. Now, historically, in perspective, back in the late 70s, early 80s, it was even higher. GDP has grown despite the fact that our debt and our national interest has shot through the roof. But this is problematic. That is basically a vertical line there at the right. And we'll be at 5% pretty quickly, regardless of what happens with rates going higher. If they stay level, because what happens is we see all of this debt getting rolled over. So because ultra short-term treasuries, 30-day, 60-day, 90-day, 1 year, 2 year was at a lower interest rate, our government in their infinite wisdom, instead of taking out a 10-year or a 30-year fix on the majority of this debt when rates were really low, they kept rolling it over on short terms. So as those pay off, then they have to issue more, and the current rates are much, much higher. So absent rates correcting in a very large way, that number is going to continue to spike.
All right. We're getting towards the end, guys. Bear with us here. All right. What are we looking at here?
Only interesting in saying, we've talked before on the show that we have people in the United States and most parts of the world that hate nuclear. France has basically been spared of worrying about Russia and the war on Ukraine and its impact on their fuel, because their fossil fuels, you see since 1985, that less than 20%. The majority of it comes from nuclear. They have some hydropower, and they're finally creeping in with other renewable solar and wind. We actually, Jeb, I believe it was in Tennessee a week or two ago, just had the first nuclear power plant come online in like 20 something years. The technology's there. We can have as much clean and nearly free energy as we want. Just hopefully people will get realistic about it. Like to show this chart, just where we are in terms of support and resistance, kind of right there in the middle. If we were to get below 399, a little room to go the other way. If that CPI comes out hot tomorrow, we could make a run back up towards the ceiling. And you guys like to see the last one here, just showing, if you notice, Mortgage News Daily is the only one of these that updates daily. So this is from yesterday. They're quoting 705 on a 30-year fixed, FHA at 671. That's a little bit high. But for the most part, don't pay attention to Freddie Mac. That will come out tomorrow. We've gone through the reasons why, but it's always hopelessly out of date. So you're seeing tomorrow we'll get a quote that's more in line with these figures, and it will probably be higher than it needs to be.
All right. Good stuff, guys. So thank you for bearing with us there. There's 134 of you watching at the moment, and there's 26 likes. So if you find any value in our content at all, the time we take, the effort, the energy, all of that stuff, do us a favor, hit the thumbs up, cost you nothing, helps support us, helps us kind of feed the algorithm, if you will, feed the beast, and let us know that you actually appreciate the content. With that said, if you need a lender, California, West Coast, Josh is your man. I will put his contact information up in a moment. It's a referral link to be able to get in touch with him. If you want to get in touch with me, if you're local here to Orange County, I know a lot of you guys watch my content. I would love to help you personally and guide you through that process. My team and I, you can use me or you can get me through that same link as well. And then lastly, if you're not following the channel, Educated Home Buyer, go over and subscribe to it. A lot of really good stuff out there. We're really trying to get more into the short form stuff. We're going to be putting more and more content out there to be able to get in touch with you guys and for you to get in touch with us and us really to help guide you through that process. So with that said, Josh, we're going to dive right into some questions. I'm not going to slow down because we've got about 30 something minutes here, right? We started the night with Esau. Esau asked a question. Could I get a seller to pay for points on my loan? If so, how many points would a lender allow a seller to pay for a purchase? So the easy answer is yes. Yes, you can get a seller to pay, but understand that, each market's a little bit different in how you might approach that. I would not, unless you absolutely need it to qualify, go into the contract asking for that upfront in your purchase agreement. I would get into escrow and then try to see if they would allow you to offer a little bit more, get a little bit more credit back, that sort of thing. Now, that's a whole different episode, but Josh, how much would they allow?
So it varies
like
on a
6%, right?
So 6% on an FHA, 4% on a VA, but there's a giant but. Lots of things are excluded, so it can actually be much higher than 4%. On a conventional, it varies by your down payment and also your occupancy. So if we're looking at non-owner, it's limited at 2%. If you're minimum down, 3%. If you're putting 10% or more, you can get to 6%. And I believe it's 25% where you can get 9% from the seller. Never in 27 years seen that, but there's practical limits on what you can do with that. It has to be bona fide discount points going to buying the rate down, not making your lender more money. And everyone gets super funny on getting on the wrong side of the law with that and is overly cautious. So there's limits both in what you would realistically want to do and what your lender will allow you to do.
All right, good. Flight Simulation Experience says, guys, I'm ready to buy a $235 million garage in Hermosa Beach. So good news. I am ready to help you buy that $235 million garage. In fact, it could just be a 2.35. Maybe you forgot the decimal, maybe 23.5. Either way,
Any
I
of
would love to
those.
help you. Just call me. I will gladly drive to Hermosa Beach and help you make that transaction possible. Just go over a couple of comments here. People saying thank you. The reason I post this, not to boast, but it's, sometimes you want feedback, right? It's always good to get feedback, whether you like it or not. And sometimes it's hard to get feedback when it's not the feedback you want to hear. But again, I'm not one that celebrates wins. I'm kind of the person that gets the deal done and I move on to the next deal without ever taking the time to celebrate the small victories. And with that, it's easy to get burnt out. So I'm going to take this moment and say, Michael's comment, thank you guys for the content. Watch, listen to every minute you've posted. So that we are very appreciative of. I'll speak for Josh on that and say very, very appreciative of the people that continue to watch it. Got Monica in here saying really enjoyed the episode on mistakes. You guys are where the content comes from, right? You guys ask the questions. We pose the answer, typically in a longer form, video and or audio, and it usually comes in the podcast format. So if you have questions, you want something to cover, we haven't covered it, you want us to elaborate on something, be sure to ask, and we'll probably deliver on it. But Michael goes on to ask, under contract for my first home in Florida, what's going on with insurance companies not insuring a lot of properties in Florida and California? Is there a foreseeable solution to this issue? So the foreseeable issue is there's not one. So here's the problem. You've got Florida very prone to natural disasters in the form of hurricanes, wind, potential flooding, other things, right? California, you have wildfires, you have potential flooding depending on where you are, just cliffs, rain. Over the last year, we've got a lot of rain, which is causing other issues. So, it's costing insurance companies probably more money than they're used to paying, right? It's kind of messing up their actuary, what's it called? Actuary schedule, whatever it is. So they're backing out. I will say my property insurance hasn't really changed very much, but my car insurance, holy cow, it went up. I called my guy and I was like, dude, what happened? Like, did something change? And he goes, what happened was, for the longest time, California, for example, hasn't been allowed to increase their rates for an extended period of time. Like the state of California, whoever manages the insurance companies basically said, you can't increase your rates. So they've had to keep them at whatever levels for an extended period of time. And so now they just got told, okay, you can increase your rates, whatever that means. I don't know all the details, but boy, did they increase the rates. So got a big jump in my car insurance. And with that, some of the discounts that were being applied are no longer applied. So it was just a big change in things when I did nothing differently. So it's a problem. There's not a easy solution. I would imagine at some point, Josh, if I had to guess, you're going to get some government intervention here, with regulation and making insurance companies do certain things to make it more affordable, because
generally it ends up having to be a government subsidy.
Yep.
But you can't force a company to lose money when they can show with actual real empirical data that these natural disasters are causing them to lose money. What happens in California? We get the California Fair Plan, and if you need a California Fair Plan policy, it's going to be expensive and ugly, but you don't have an option because there's no private company that will issue it.
Yeah. And that was one of the other things, right? Is that these companies have been, basically the car insurance company are showing that they're not making money at the rates. And so therefore that was changed, and rates have changed, and so on and so forth. So anyway, not the answer you probably wanted to hear, but it's the only answer at the moment. I would imagine there'll be a solution, but it's not going to be immediately. Wesley, flawless first 5 minutes we had, Josh. Holy cow. Now we've been in 35 minutes. So are we still flawless?
Hopefully still flawless.
I mean, that would be a hell of a deal if we were still flawless at this point. Danny, agent up in Northern California, asking Santa Clarita. Where the hell is Santa Clarita? Is that I'm drawing a blank. That's Northern California, or is that LA? I don't remember.
Santa Clarita is the far
That's
side of the valley.
up near San Jose, right? Yeah.
No,
Where's Santa Clarita?
like out Magic
Are you
Mountain
looking
area.
at? You're looking it up right now. You're cheating.
No, I
You
will. I
forgot.
will look at it. No, it's up by like Magic Mountain.
That's okay. I forgot.
Yeah, Santa Clarita is a California city north of LA. It's known for Six Flags Magic
Okay,
Mountain.
there we go.
I
So
didn't.
it's in the valley.
I thought it was past Six Flags.
I didn't know. I forgot. No, not going to Tom Ferry Summit. So Tom Ferry is a real estate coach, educator, all things real estate marketing type coach, and puts on an event every year. We will not be there, but I do follow him online. Kim asked the question, what is conforming and super rates? And what is the difference between the two? Is it about credit scores? So what are super rates, Josh? I have no idea what's being asked here.
So sometimes it's called high balance. Sometimes it'd be called super conforming and super conforming. So you have the maximum loan amount, 726,200. Above that, if you are in areas that offer them, you have high balance or super conforming up to $1,089,000 and change, $1,089,300, I think is the number. And with that, you will have a higher rate. So you pay about 1/8% premium. And if you're putting minimum down, which once you go above that to high balance or super conforming, 3% down is no longer an option. You have to do 5%. And on a purchase with less than 25% down, you're going to have about a 1 point add to your fees, which most people don't want to pay $7,000, $8,000, $10,000. So they're going to take a 1/4, 3/8, 0.5% higher rate. Jeb, you and I had a client this morning. You needed a pre-approval letter, and they went a little higher, and it pushed us over that 726,200. We had a little shock when we ran it through.
When I saw the rate, I choked. I was like, "What?" But fortunately, they had a little bit more money to put down, and rate came down by 0.5 point. So anyway, all right. Got some additional good questions here. This is a really easy one. I'm just going to throw it in there. Or actually, Gerald corrected me. Santa Clara.
Gerald helped you.
That was what I was thinking. So good stuff there. Charles, hey, love your show. Do you think homeowners who are on the sidelines to list their homes may feel the FOMO if home values are expected to come down? Thank you. I don't. I think, if my interest rate is at 2.5%, why do I care, what's going on, right? Here's the problem. Let's start there. The problem is most people are watching the property value like it's cash in hand. It's never cash in hand until you go to sell that property, right? And so I think most people realize that, nothing is done until it's done. And that by selling or trying to get out quickly, you will have some people do that. And the problem is those people will be renting and won't own a home, maybe ever again, but if anything, for an extended period of time. And I can say that speaking from experience with clients who have thought the same thing in the past. Rates are going to come down. House prices are way too high. Housing affordability is way too high. I'm selling. I'm going to buy when it's lower. Okay, you just missed 50% in appreciation by playing that game. It's not a game to be played. It is buying when it's the right time in your life, selling when it's the right time in your life, upgrading when it's the right time in your life, and not getting caught up in the FOMO and doing all the other things. Really simple. But will some people do it? Sure. Will it be the majority? No, I don't think so. Josh, easy one here. Softball. Do you think the Fed will continue to raise the rates before the end of the year?
I would say 60-40, they're done, but the head fake can be with the data tomorrow. And if we see a headline, not a core number, we talked about the core is likely to continue to moderate through the rest of the year. But if energy prices and especially if food tick up over the next month and we see 2 consecutive months of headline numbers, even though the Fed is saying they're not looking at headline, they're looking at core and even sometimes talking about super core, which excludes housing as well, they could. I hope not. I think that they have done more than enough, and we will see a softening in the labor market. We saw the chart. The long-term trend is a slow grind lower in terms of jobs created. So hopefully they don't, but there is a possibility they might.
All right. Pizza McGee. I just read the name and immediately start salivating because I love pizza. I could eat pizza every day. Wouldn't be good, but I could do it. Does a shopping center add value to an area, house, building one close by? So it can. Depends on how it's done. Is it done in a nice way? Like not just thrown up, right beside a house type thing. Typically when you add like infrastructure, and I'm not necessarily talking about streets and schools and stuff like that, but shopping centers and that sort of things to areas, it could add some value depending on, what goes into that shopping center. Is it a grocery store? Is it, restaurants and things that will drive traffic and potentially more money to the city? Those are good things. If it's a Walmart, not to crap on Walmart, but like nobody really wants them by their house because it creates traffic. It creates all these other things. So there's cities that fight against them for whatever reason, right? I mean, rightfully so in some regard, but it depends on what type of shopping center it is, what goes in there, how big it is. All of that stuff matters, but typically that means you're in an area that's growing, and areas that are growing are usually having jobs and business creation and that sort of thing. And usually those are positive signs for housing and for the local economy. Josh, let's see here. Question: why does the government look at job openings instead of unemployment filings? Can't companies skew the numbers?
So they do. They look at all of them. So tomorrow we're going to get the weekly claims data. They look at, you hear about the JOLTS data as a job openings.
So maybe explain what claims data is first, Josh.
So it's weekly unemployment claims. How many people filed a new unemployment claim saying, hey, I got laid off in the last week and I got in. So someone doesn't have to file right away. They might have got fired 3 weeks ago and they go down and they file. But generally, people are going to file right away and want to know what their situation is. They also talk about continuing claims. So we can look at two pieces. Continuing claims tell us how many people are not finding a new job and just taking unemployment. So you want to see low continuing claims, and you want to see not a lot of new claims. Right now, because the Fed's focused on that in terms of interest rates and the Fed stepping away, they are looking for more weekly claims. So tomorrow will be interesting. That will be a market mover. We have, I believe it's a 30-year treasury auction, can be a market mover, but the 10-year treasury auction today was very good, which there was some fear in that because of the additional supply. They're selling more treasuries to finance that big debt we talked about earlier in the show. So we're going to see all of that with CPI on Thursday. It's going to be eventful.
Tomorrow's a gangbuster day. By the time you wake up, by the time most people wake up, the market's either shit the bed already or it's in a really good place. So, if you want to wake up to good news, you might want to get up before the data comes out.
And Jeb, all of these things. So job openings, that's the job openings and labor turnover support.
Yeah, that won't be tomorrow.
That was just a week or so ago. Yeah. And we're seeing it's trending lower. There are less jobs open. And we've talked about that can be skewed because they're looking at job postings around the country. Jobs can be posted in multiple areas. We have another question here along the same line. Rod says, why doesn't BLS report weekly unemployment rates? That is a very involved report. They are surveying businesses and they are surveying households. It takes the better part of a month to do that, compile the data, and release the report. So it's just,
and even those reports are somewhat shoddy at best,
and have big revisions for up to 2 and 3 months later.
Yeah, so even that you got to take with a grain of salt to some extent. Teresa came in and said, thank you for the last response. Can you share how much politics election 2024 plays into the market, benefits, issues when you want to buy and sell residential? So I would say less than you probably think. What happens, at least in my opinion, in election years or leading up to an election is you get the party who's in office at the moment, talking about, all that they've done for housing, whether it's good or bad or whatever. And then you've got the people that are coming in talking about all the things that are wrong with housing and all the things they're going to do to change it and make it more affordable for those that don't have it, right? It doesn't matter which side you're on. It's the same story, both directions. What I will say is most of that's garbage. They can't follow through with it for a number of reasons, but more so just because of how it's done, right? No one person makes a decision here. And so regardless of what side you're on, understand the person you're voting for has very little power at the end of the day. They do have some power, but there's a lot that's involved there. So it's always fascinating to me that people that get so caught up in politics and think that whoever is the best or the worst or whatever, it's like, dude, that guy's he's along for the ride. But nevertheless, so election years, historically speaking, the markets have typically done better. This isn't a political statement when a Republican's in office and vice versa, right? Markets done not so well in when you have a Democrat in office. Now, is that for any other reason other than, what happened prior to them coming in? You don't know, right? Housing doesn't change immediately. It takes years and years. So sometimes people are in office for what happened 3-4 years ago. It's just taking effect now in the market that they're in. So I would say don't get caught up in that. I think it's going to have less of an effect than you want it to have. If you're rooting for it to go up, it's not really going to matter. If you're rooting for it to go down, probably not going to matter either. So that was a long way of getting to what I was saying, Josh. But what are your thoughts?
I say the same thing. Everyone, presidents get too much credit for good things that they didn't necessarily control that much, and they get too much blame for bad things that they didn't control that much. The exception to that, in the last 20 years, we've allowed presidents to make these executive orders, which it's funny when your guy is in the White House, you think it's great that he can just say, hey, we're doing this. And when the other guy is in the White House, that is evil and terrible. But the crazy thing is the executive orders don't have any permanence. The next guy comes in, if he's from the other party, he just erases all that stuff. So we got this game of ping pong back and forth. So in general, you're 100% correct, Jeb, that they don't have that much impact. And in the long run, I don't think really any impact at all. In the short run, people's perception will kind of move the market around.
All right, I'm going to post a comment here. And the reason I'm posting it is because this is kind of what we were talking about earlier. So Orlando says, my guess is that inflation will be up tomorrow. We will see. We shall see. So inflation is going to be up tomorrow. There's not really a guess. Inflation is going to be up tomorrow.
It would be shocking if it wasn't.
Yeah, it would actually be more shocking that if it wasn't than than it is, and that's because of how they calculate the CPI number, right? It's month over month numbers added up for 12 months. That's essentially the CPI number. So you're taking off a 0.0. That was last July. So any number above 0 will make inflation go higher, right? On the flip side, though, we talked about it. Core inflation, there's a chance there that it goes lower because taking out food and energy. But what I want you to pay attention to is when the media comes out and the Wall Street Journal writes the headline that inflation is up, it's trending up, it's back up, it's going up. Yeah, it is. We're telling you here right now that is going to happen. It is not a surprise. And if I know it, it's really not a surprise, right? Because I'm not on the inside. I know nothing. So again, it's, Orlando is accurate. It's going to be up. But should you be worried about it? Probably not. All right, Josh.
We have the most important question of the day.
Oh, boy. Let's see this.
Eli comes back and says, will UW's move to the Big Ten affect home prices in Cheney and or Spokane? No, not for Cheney, because Cheney is home to the Harvard of the West, Eastern Washington University. And so therefore home prices are impervious to downturns there in Cheney. Spokane is an interesting market. A lot of California money went up there. So we've said that it could be at risk. I don't think other than just the tragedy of the Pac-12 imploding through the stupidity of the conference presidents over the last 12 years. Well, I would say I wouldn't be shocked if it had a little of an impact on Pullman. Pullman is all out there by itself, and there are 5, 6, 7 hotels in town that really are sold out. Mom's weekend, dad's weekend, graduation weekend, and the 6 home football games. So I wouldn't want to be a hotel owner in Pullman right now.
Good stuff. Kim asked the question, could we do a podcast episode on what insurance should new buyers purchase and how much of it and not getting ripped off without breaking the bank? So, Josh, I will be 100% transparent to you and to the audience. I know little to nothing about what somebody should insure on their home other than the replacement cost. And even that is questionable to some extent because of where building costs are and that sort of thing. So maybe if you're an expert, you can write the outline and we'll read it. Or if you guys know, is there a YouTuber out there that's an insurance person that has a following that actually knows what they're talking about, that is not there to sell insurance so much as to educate you on insurance? If so, that'd be a really good connection or a good person to know and have a good conversation with in more detail. Josh, do you know a lot about insurance?
Enough to be dangerous. I was going to say we could ask ChatGPT, but sometimes they give horrifically wrong answers. So we could just do a whole episode of just spewing the crap that GPT comes up with.
That's great. No smart YouTuber would be an insurance person, Wesley says. Not a good way to build a following. I would say the same thing for a real estate guy, right? Not really the best way to build a following when you're calling crash videos all the time and you're trying to sell real estate. Makes for a really weird dynamic.
Those are the ones that amaze me, are the people that are realtors for a living. And it's like, okay, I get it. If you truly believe it, you should say what you believe. But what are you doing for a living when you're screaming to people to not buy homes? Are you telling everyone to sell? You're going to be a listing agent. Hey, everyone list your house. I'm going to help you get out before this massive
Can you
downturn.
imagine, like, who would want to be a listing agent when homes sit on the market during a crash, like 18 months? Like, that's what it was, guys. You're like, right now, days on market on average, I think nationwide's like 17 days or something. Here in Orange County, where we are, it's about 45 days. During the downturn in the market, I don't know what the average days on market was, but I had properties that sat on the market for a year, 18 months. Do you know how many conversations I had to have with the selling agent, sometimes with the homeowner, sometimes with the bank when I had foreclosures, about what was going on? Like, too much, guys. Way too much. Way too many conversations. Like, what I was making per conversation I was losing money on that deal. All right. Josh.
Jeb,
yep.
A couple good ones here. Let's just throw this one first. Shadow Rich, assuming now is the right time to buy a home in your life, would you buy a home or buy a home? Would you build a home or buy a home with an inflated value? Construction materials are also high at the moment, but at least it's new. Before you jump in and answer, Jeb, it's funny when people put either a false premise or assume a premise in their question. Buy a home with an inflated value. Inflated relative to what it was? Yes. Inflated relative to what it's going to be? Doubtful. So let's just take that away. Would you build or buy in the current market, Jeb?
I think there's a misconception, I've said it many times, about people think it's so much less expensive to build a home. And they also think, and this may not be you, so I'm not stereotyping, I'm just saying in general, right? And people also think that you can just go in and get a loan to buy the land and build the house and all of that, and it's very easy. It requires money. It requires down payments on both the land and the construction loan in order to build a house. So if you are a person out there and you have no funds, building a house is not really an option to start with. Secondly, the cost to build, because of labor costs, because of construction cost, lumber and that sort of thing is kind of had come back, but other prices on things are still high. So it's more money, time, effort, energy, all of those things to build a house. I would say that most people, for the majority of people out there, if you don't own the land already, you don't have any down payment, it is much better to just buy an existing home. If you have the land, you have some cash, building, and you're very particular about what you want, nothing out there fits the bill, whatever, then building may be the best option. And it could be a really good option. And you might build it and actually have some equity in your property once you're done. But I would say that is a small percentage of the people out there that are asking that question for the most part. So we could do a deep dive into it. I've done videos on it on my channel. You can search them around new construction. We go about the pros and cons, but a lot of people they don't factor in a lot of the things that they need to be thinking about when they think new construction. Really
Jeb,
simple.
We haven't looked at this chart for a while, and this question leads us to it. So let's throw this one up here. I noticed 10-year mortgage spreads have lowered a bit from the past couple of months. Is that trend going to continue? So you saw back in the fall, we almost hit 3. Then in March, we did hit 3. In June, we hit 3.10 and have backed off to 2.84. So it's about 0.25% lower spread. So, it doesn't look like much on the chart, but 0.25% is legit. Do I think that's going to continue? I do. Is it going to be a straight trend? And is it going to be a rapid return to that normal 1.7, 1.75 that we saw for the last 40 years? Probably not. Servicing values are depressed right now. Lenders are not sure how long those are going to stay on the books if rates were to start dropping rapidly. So it'll be interesting to watch. I think it will normalize, but slowly over time.
All right. Good stuff. Josh is the expert on the 10-year. So nothing to say there. Here's what I'll say, guys. There are people out there now that are professionals that teach on rates and have subscription services for rates, and big profile names, not going to mention them here, that are talking about what Josh and I were talking about 18 months ago when this was a thing. And not to say that Josh or I were leading, people on this, or anybody got it from us. It wasn't that. It's just that we both read a lot. We both watch a lot. We both talk a lot in conversation. And we were talking about that very thing a year and a half ago, Josh, in how the spreads weren't normal and how that was creating issues in the market. And now it's like, it's conversation. Everybody knows about it. Why? Because it's been talked about so much since then. So what I will say is there's a lot of value to be gained in these conversations. I don't necessarily, you don't need to sit here for an hour and a half or hour or 2 hours, whatever the episode is, but there are things that you can gather here, just small tidbits, and take with you that could, help you make better decisions. So just food for thought.
I saw one today. I don't know why, because I don't subscribe to this person's service anymore, but I got an email, the end of day update, from the guy who was the very first bond market expert that I followed when I got into the business way back in the 90s. So he's an older guy. He's like late 70s now. And he was talking about inflation. He said, I just don't see inflation going down. These companies are not going to lower prices. And you're like, bro, it doesn't have anything to do. Inflation is a rate. No one has to lower prices for inflation to go to zero. If they don't raise them at all in the next 12 months, inflation goes to zero. So it's just, there's a reason why you and I both like to read a lot of sources. You start to realize everyone is biased in many ways. Everyone is biased. So you start to learn people's biases, their blind spots, their hopes, their wants, their dreams. And by reading a bunch of people, you can come to both your own opinion and also what is the most likely course of action. Although I was talking to my financial advisor yesterday, he's buying a house right now in this current market with these elevated prices, inflated prices. And we were talking, said, I know more than 99.9% of people following this. I know half of what I thought I knew 10 years ago. And he said 100%. He just started laughing. He goes, that's exactly it. The more you watch this stuff, the more you realize you don't know. So all you can do is educate yourself and start thinking. I've talked before on the book by Annie Duke, Thinking in Bets. What are the odds? This is what I think I know. How certain of that am I? And I think it's good for all of us. You are not certain of anything. If someone said, hey, you're confident of that, cool. We want to play Russian roulette. You put a gun to your head and pull it. And if you're wrong, you die. Most people would say, no, I'm not that confident, but they'll tell you adamantly, certainly make crazy YouTube videos with spectacular headlines that they know exactly what's going to happen tomorrow, despite the fact that they have no clue.
All right, we're just going to take a moment of silence here and let that sink in, guys. Let that sink in for a moment. All right, where are we? We're 5:57. Maybe we'll go over a little bit here, answer some more questions. Tiffany asked this question earlier. Do you do commercial real estate? The answer is no. Josh doesn't really do commercial. Could he help you with a loan? Potentially.
Well, here's the thing, Jeb. At United American, we have an expert. That's all he does. So if we have a client that needs that service, we work with him to provide it. So yeah, we absolutely do have someone who can do a great job. Very unique, very different, and very time consuming if you don't do it on a regular basis. That's why we have him here to do that stuff.
All right. We have Azrak.
That's a one.
Close enough. One. Do you see correlations with the stock market and the housing market? If so, do you expect markets to move sideways over the next couple of years? Would a market crash negatively impact the housing market? So do you see correlations with stocks and housing? In a way, yes. When the stock market is doing really well, that puts money in more people's pockets. Typically, more money into the economy, more people spend and in turn buy houses, right? The wealthy, there's a lot of homes purchased over the last couple of years, luxury homes, big price points. Why? Money was cheap. Market was doing really well. People were feeling really good about themselves. As at the moment, the stock market's still doing fairly well. I mean, really well, all things considered. And so if you see the stock market pull back, you're likely to see not the housing market crash, but you're likely to see some pullback in activity in a normal market. This market's weird because there's not a lot of inventory to choose from. And so even though demand is low, inventory is low, there is just, it's weird, right? So if you're asking, would a big drop in the stock market now have a big drop in housing right now? I don't know, because I don't know what would happen with inventory. Maybe some people would need to sell, get money for other things. I don't know. But most people don't live on the stock market. They don't live off the funds they're creating off the stock market. For most people, it's a retirement. It's passive income to some extent, compounding over time. It's not what they're using on a day-to-day basis. So for the majority, like if the stock market crashed tomorrow, it wouldn't affect me at all, right? It would suck. I got a lot of money in the stock market. I wouldn't like it, but it wouldn't change what I'm doing today, if that makes any sense at all. But Josh, what are your thoughts?
You see a wealth effect when the stock market is doing well. People get really confident when you're, and at risk of being one of those, hey, making fun of boomers. Well, boomers are the ones with the big 401k balances or retirement account, and when the market's up 20%, like isn't it close to 20% year to date, Jeb, like 18%?
Something like that, yeah.
Well, if you have $1.5 million in your 401k and you look up, you got $1.8 million, $1.9 million, you're feeling pretty good about yourself. You will be more confident about making decisions, because that person probably doesn't make $300,000 a year, but they just grew their wealth by $300,000. So that's the biggest correlation that I see, is people get more confident and make bolder decisions when the stock market is up. And on the flip side, let's say that person runs their balance up to 2 million and we have a 20% downturn and they're at 1.6. They go, ooh, this sucks. I don't have any money to spend on a bitchin' new house.
No, yeah, all of that matters. So just know, but a stock market crash per se doesn't create a housing market crash. Right. It doesn't necessarily, it's not a 1-for-1 correlation. You could see some trickle effect to some, especially in certain price points and what have you. But for the most part, it's the two are, is that you or me? You ringing? Somebody ringing?
I got no ringing. Maybe when the audience is ringing and you're hearing it.
Listen. Oh, that's me.
Oh, this guy's trying to blame me and he doesn't turn his phone off.
I was like, that sounds funny. Hey guys,
it wasn't even Stapleton.
I was so focused. I was so focused on the show. I didn't even realize my own. I was like, that sounds like my ring. But I usually have my phone right in front of me. So nevertheless, hey, you guys get the real deal here. This is really what happens. Jeb is so focused on the show, doesn't even realize he has it. His own phone's ringing. So guys, we're just over 6 o'clock. Been on just over an hour. Couple questions here. Josh, we'll get off. Jeremy says, guys, love the channel. I'm currently building a house and really watching interest rates, hoping my home is done around January, February. Any chance we see rates around 6%? So I want to build off that. I'll let you answer the question in a sec, Josh. One thing you need to keep in mind when you're building a house, you're going from a construction loan. At some point, you got to go construction to permanent, right? You got to get an actual loan on the house. And so for some people out there, if markets continue to go up, with volatile rates, you don't know where rates are going to be at the end of that, right? And that creates chaos when you're buying new construction from a builder, but it also kind of creates some chaos when you're buying new construction or building a house, if you will. So just know, if you're planning on building, these are things that you got to think in, unless you're able to pay cash, you're going to have to get a loan. And does that loan, where are rates going to be at that time? Does that make sense? Those people that could have bought in 21 and decided to build a house and it's taken 2 years to build it, they're probably going, shit, I should have just bought a house. Like, I probably shouldn't have built this thing, right? Because rates are quite a bit higher than they were then. So again, just something else to think about. But Josh, any chance you could see rates around 6%?
Yeah, I don't think it's likely. I think we will trend in that direction between now and then, based off of.
You don't think a 6% handles by January, February?
He's saying rates around 6%. Now the 6%
can
handle.
happen.
You and I ran the number. You and I ran the numbers this morning for Lucas at 6.99. So is a 6% handle? Absolutely. Is that the same as around 6%?
I think I'm seeing around 6% by then.
It's possible. I wouldn't bet on it. I would say mid sixes, possibly lower. I hope you're right.
Stand for something or fall for everything. I'm standing for 6% by the end of the year. That's I'm going
to get you a new T-shirt that just says 6%.
Hey, listen, I've been wrong so many times that at this point it doesn't even matter. Like I'm going 6% by the end of the year. That's my call.
Hey, Jeb, we
Yep.
actually have a comment question that I think is good. It'll be helpful. So Eli comes back and says, a can of black beans went from 99 cents to $1.99 in 6 months. So if they're still $1.99 in August 2024, does that mean 0% year-over-year
Yes.
inflation? Yes, 0% inflation in beans. Does it still suck that your beans are twice as expensive as they were 18 months ago? Yes, but it means there was zero inflation year-over-year. That is exactly how it is measured.
Yeah,
So now
inflation
imagine an
is a rate,
entire
like Josh mentioned. It's growth, right? It's a trending price continuing to go up over time. Once the price stabilizes, inflation's out of it. That is the price. High prices suck. High prices are not inflation, though. They're inflation from a previous time, right? They're inflated, right? But doesn't mean you still have inflation. So I think a lot of people get confused with that, Josh, and rightfully so. But they're like, hey, dude, it's still, eggs are still, or milk is still $5 a gallon. When I was, whatever, it was $1. Well, yeah, it was $1, but prices go up, guys. Todd Sachs just gave us $10. Said, thank you.
How do you know? I just see Sachs Realty. How do you know it's Todd Sachs? You know everyone? All
You've
you
talked to him.
realtors? There's a big cabal of realtors that you all know each other.
You've talked to him. What's up, fellas? See, he even said fellas. Probably knows your name. Anyway, guys, it's been on 6:05. I don't know if Todd has a question or just wants to comment or what, but
Well, he wanted to say, hey, what's up?
It's me, he says. So
it's not an
appreciate you being
imposter,
here.
Todd.
We appreciate the super chat. Mr. Sachs is also a real estate agent out there with a YouTube following. Go check his channel out. If you're looking for a different perspective on housing, he has one to some extent. So go check out the channel. With that said, Josh, we are 6:05 in. What I want to ask at the moment is, again, if you're not subscribed to the channel, please do that. If you like podcast, you like deep dive into topics versus Josh and I covering a lot of different things here in Q&A, go check out the Educated Homebuyer podcast. It's on YouTube, has its own pretty little YouTube page where you can find really detailed, deep information, conversation style, where we go over mortgage and real estate related topics. Again, next week is budgeting. Really good episode. I think one of our better episodes, Josh. Last week, we talked about Dave Ramsey. We talked to Dave Ramsey. He wasn't there, but we talked to him. So if you want to hear our conversation with Dave Ramsey, go check out last week's episode. And if you want to get in touch with myself or Josh, there's a link scrolling at the bottom that will also get you in touch with a lender or real estate agent anywhere in the country. But Josh, final words.
I'm going to do final answers, 2 12-second questions. Rodney wants to know interest rate with a 620 on an FHA. Locked one today at 6 3/4. He had to pay a little bit for that. If you don't want to pay anything, it's going to be high 6s, low 7s. And Eli back with a trick question. If you had to choose today between seller incentives, 3 points to buy down 30-year mortgage or a 3-2-1 buy down, none of the above. Use it to pay all my closing costs so that I have my powder dry for my refi in 6, 12, 18, 24 months.
All right, guys.
Final words.
Final words. Buy right, borrow smart, build wealth.